Good afternoon, everyone. I, Shashank, on behalf of NEN and Wadhwani Foundation, would like to invite you all for this webinar and also introduce our experts. Rahul Raghavan is the investment manager of Venture East Advisors. His core areas of interest are education and technology. In the past, he also managed the BYST Growth Fund, a pioneering VC fund that invests equity in everyday, non-IP holding micro and small enterprises. Rahul holds a BTech in Engineering Physics from IIT Madras, where he graduated top of his department, and an MBA from IIM Bangalore, where he graduated in the top 10 of his batch. Moderator and host for today, Rishabh Kaul, till recently was an associate with Avishkar, an early-stage venture capital firm where he was sourcing potential investments and working across agribusiness and healthcare sectors. Most recently, he helped launch and run Spark Angels, BITS alumni's own angel funding platform. Rishabh holds a master's in economics and a BE in civil engineering from BITS Pilani and was part of the founding batch of the Young India Fellowship, a liberal arts program in collaboration with the University of Pennsylvania. Before I hand over the floor to Rishabh and Rahul, here are a few reminders for the audience. You will all be on mute. You may ask a question by typing in the panel provided. Over to you guys.
Thanks, Shashank. Hi everyone, this is Rishabh and I'll be in conversation with Rahul from Venture East. Firstly, a lot of thanks to NEN for organizing this series of webinar. I've been associated with NEN in the past. I remember interning there a long while back, and it's really phenomenal what NEN has been doing for almost over a decade now, providing a lot of material for inspiration, supporting early stage entrepreneurs. So today I have Rahul Raghavan with me from Venture East, and we'll be discussing the sort of key points to keep in mind when you're raising your first round of venture investment. Before that, just a couple of reminders that you have the box to the right where you can throw in your questions. I'll be bunching a few questions and periodically throughout the webinar asking Rahul to address these questions. Please, post the webinar if you have any questions or would like to continue conversation. Rahul and my Twitter IDs are here, and we can obviously take it further online. And please, if there's any feedback or any thoughts from your end, please do tweet with first round VC as the hashtag and do tag any in India in that. So with that, I think we can dive right into this. I think it's a very so when my friends at NEN had asked me that we should basically around ideas of what all should the first round of VC investment cover, and who would be the person who would be an expert for this. I was very excited by getting on board team from Venture East because for a couple of reasons, right? I think venture capital and private equity in India in general is a very nascent phenomena. I think 90% of the funds that have come in the last 5 or 6 years. Venture East being an exception to it. They are one of the earliest venture funds in India. At the same time, if you had the time to go through their portfolio, I think it's a fantastically diverse portfolio, right? So I mean, you will find a lot of sectors being covered, and that gives them sort of a unique vantage point of when they speak about entrepreneurship, because they've just seen so many sectors across so many funds. So I'm very happy to have Rahul share the screen with me here. Hi Rahul.
Hi Rishabh. Hi everyone. Thanks Rishabh for the warm welcome. Very happy to be here.
Great, great. So, just to start off with, I know that we were having discussions on, how do we address this topic, because I think for the longest time ever, there have been so many discussions around raising venture capital, and there have been, numerous webinars, discussions around what is it that entrepreneurs need to keep in mind when they're raising their first round of VC investment. So I think to sort of add another dimension to it, it'll be great to hear your views on what is it that the early stage VCs are looking for, and how is it that those expectations and what they're looking for, how is that different from an angel or a seed investor or an incubator?
Sure. Okay, so let me take the early stage question first, and I'll try to throw some light on that, and then we'll talk about seed investing and angel investing, right? So I'd probably say there are three things that I look for, when we're evaluating an investment. Number one, what's the team like? What's the entrepreneur like? What's his background? Who's the number two guy in the company? What's the second level management team? This is the kind of evaluation that is most important to us. The team, irrespective of what the business is, how well it's doing, if the team doesn't cut it, the deal doesn't happen. Okay, it's as simple as that. I think we can also get into questions of, is pedigree important, and that people ask me a lot. Does it matter if you come from an IIT or from say BITS or perhaps another engineering or even a commerce college? And the answer to that is yes, sometimes it matters and sometimes it doesn't. I'll go through when it matters. So team is number one, right? Number two, and also probably as important as the team is something that we call clarity of thinking. Okay, and this is purposely defined somewhat vaguely because it covers a bunch of things. It covers how deeply you've thought about your business model. It covers how deeply you've thought about the competition in your space. It covers how deeply you know about what the risks are in your company. And that's often the key thing that most entrepreneurs are not very familiar with. They all think, on the bright side on how great the opportunity is, but often not enough thought is given to what the risks are. So, when I talk to an entrepreneur and I get a sense that the entrepreneur knows really well where the challenges will lie, that's usually a very good sign, right? I mean, I'm taking out the fact that the business needs to have a big market, that it needs to be scalable. All of these I'm taking as a given, okay? Beyond that, the clarity of thinking in terms of the risks, the landscape, how you plan to add people to your team, the strategic views, that's number two, right? The third thing, and this is where the difference comes in between early stage and seed stage, is traction on the ground. Okay, so the early stage investor will typically invest at least 10 crores in a company. Okay, at the very least, it starts from 10 crores. It could go up, all the way to 30 or 40 crores. But we'll only invest that amount in a company if that company has already demonstrated at least a couple of crores in revenues, annual revenues. Okay, that's the very least. If you have anything less than that, then you're probably not ready for early stage funding. So we don't go simply by the idea. We look at the idea, we see what you've done to demonstrate that you know how to execute on a small scale. So that might be in a particular geography, or you might just be particular campus focused, whatever. But you've shown that you can execute, you can build your business to about 2 crores, then you come to us. You say, hey, you know what, I think I know how to do this business on a small scale. I have the plan to grow it on a large scale, give me 20 crores, right? And that's when you're ready for early stage. The seed stage investor will often invest at an idea stage, okay? And this is often true of the angel investor also, perhaps more true of the angel investor, where you go to the angel, you say, hey, I've got this great idea. I'm in the process of building a prototype or an online say an app or a web app, whatever. And you go to the seed or the angel investor and you say, do you buy this idea? You try to persuade the investor that the idea is great. You haven't actually built all of it yet. You probably built only a small part of it. but the seed stage investor will look at it and is happy to take that risk. Okay, so summarizing the three: one is team, the second is clarity of thinking, third is traction on the ground. Okay, we need at least two of these three. Right, so you'll often see deals where the team may not be of great pedigree, they may not have professional experience in that particular field, but they've shown traction on the ground and they show that they're really deep thinkers on their feet, and the deal gets done. Right? Alternatively, you have a great team, and that great team has already shown that they've grown at about 5 crores very quickly. We know that they can figure it out because, hey, they are a great team, right? So the deal still gets done. Right? So typically, two of these three things: team, traction on the ground, clarity of thinking. Two of these three for sure. The seed stage guy will just look at the team and he will look at how clear your thinking is and how good the idea is, and he'll go ahead and do the deal. So hopefully I've covered most of it there.
Great,
Rishabh.
great. Yeah. You've while these are the things that you mentioned that you would be looking for, I think illustrative examples always end up providing sort of adding another layer of perspective to that, right? So I thought I could very quickly get a sense of you from just once, get a sense of what is the worst position to be in when raising capital, and this is coming from the fact that every day on different forums you have a lot of people that come forward and say, hey, I'm about to raise my next round of capital, what are the things that I need to keep in mind? So what do you think is the the few periods when it is really a bad time to be raising institutional capital, not just from the point of view of where your particular business is in, but maybe even taking into account macroeconomic factors, just to get your opinion.
Yeah, sure. I think so. Obviously, there's something of a paradox here, right? When you really need the money, nobody wants to give it to you. When you really don't need the money, people are lining up, knocking on your door. Okay, and that's the fundamental sort of paradox, if you will, not just of venture capital, but possibly all of finance. That when you don't need the money, people want to give it to you. So worst position to be in is if you have less than 2 months of cash left in the bank. You possibly don't have the greatest traction in the world. You just have a good idea that has shown some promise, but you haven't really been able to prove it yet. At that point, it's looking very, very hard for you. And for various reasons, right? Somebody might still have faith in the team. They might still have faith in your business model itself, but you can be sure they will beat you down on the negotiations and the valuation and so on, right? And it's just classic supply demand, right? If you have a bunch of people wanting to invest in you, your valuations will go up. In the case when you don't have much cash, when you're really struggling, that's when you don't have much bargaining power. And I can talk with my experience, in the sector. We see a lot of companies which have received the first round of funding and burn through it very quickly, and then it's a real challenge raising the second round of funding because everyone comes and asks you, hey, what have you proven with that first round? And guys who are going for angel money need to be very careful because you've raised the angel money, so the bar is even higher for the early stage investor who's evaluating your business. And you really need to make that money count, plan ahead of time. The thumb rule we use in the business is if one of our companies has only about 6 months of cash left, that's when we go to the market and start raising the next round. And 6 months might be a bit too long for smaller companies, but certainly 2 months of cash. I think anything less than that, you're in trouble.
Correct. Is that also because fundraising can sometimes end up becoming a full-time activity for the entrepreneur?
Oh yeah, that's a good point. I think every entrepreneur here must be prepared to spend a lot of time fundraising. If you're serious about raising equity capital from institutional investors, it's a shame. Ideally, it should not take so long, but it does. And that's just the fact of it. So it is a full-time activity, which is why we're so keen to know what the second level team is. because we know for sure that not just at the early stage, not just at Series A, but often at Series B, which is the subsequent round, the promoter or the CEO spends a lot of time talking to investors, putting together his pitch, meeting them, negotiating. It's perhaps not a full-time activity, but it takes well in excess of 50% of your time. So you absolutely need to budget for that.
Got it. Got it. And so, you did mention that if there's a very, if you are short of cash, then there is, and that doesn't put you in a very good situation. Would you have any pointers on what could the other sources of funding be, just to keep the boat steady, or something that you would have noticed?
Yeah, so that's the tough one at early stage. I mean, I know that a bunch of banks have now gotten into the role of providing short-term working capital funding for technology startups. I know SIDBI does it.
Right.
A couple of ICICI I know used to.
Even I think even Dana Bank has a new venture debt
right.
program that they've been. Yeah.
Right. So there are a bunch of banks which are getting into the game. But banks, they're not going to move fast. They're going to possibly need a lot more documentation than you can ever provide. And they often are not very happy looking at service businesses. They like to see, actual assets on the ground. And that's often challenging. So if you just have some technology or some IP, it takes a good deal of convincing. Which is why, again, come back to the point, plan well in advance. Don't leave it late, because it's often likely that that it's going to take longer than you expect, almost always, right?
Mm-hmm. So, is there any role of signaling which takes place at the first round? So, for example, you've got a couple of angels and you've got, say, an initial seed stage investor, or say an incubator that's put money in you, and in the next round, since we're still on the topic of the worst position, they say that we don't want to put in any further capital. Does that affect the next round VC's decision on whether to go ahead, or is it completely independent when they are evaluating a proposal?
No, so that's a good question as well. I think what we've seen in the market, and what we know from just general psychology, is that nobody likes to accept that their investment is dead. So if your angel or your seed stage investor, if he sort of informs you that he's not going to follow on with additional capital, he's going to tell the outside world that he doesn't have the cash at this point, which is why he's looking for outside money. He's not going to tell the world that I don't believe in this company anymore. Okay, and that works to the advantage of the companies, particularly at angel and seed stage, where that's a true reason, right? These are small investors; they don't have much cash. Where it really hurts you is going from Series A to Series B. If the Series A investor is not willing to participate in Series B, then questions get asked: Why is this guy not participating? What does he know that I don't know? Because he's been on the board for so long. He's been evaluating the company. He's worked with the promoters and the team. So if he's not participating, that's usually a bad signal for an incoming investor, unless the signs are very clear that they're out of money, or they've already invested all their capital or something like that.
Right.
So yeah, it certainly has a signaling role, but I would say not so much at the angel and seed level. Certainly at the early stage and the Series B level, it's a big factor.
Right. So that takes us to what would be the best position to be raising institutional capital?
So this is again, it's again the converse of what we spoke about last time. If you're doing really well and you have a lot of traction, people will bang on your door. Okay, I know that lots of companies that necessarily did not go out looking for funding, but lots of investors reached out proactively to them. And this is typically true of a bunch of internet services and apps and so on, where you can tell which apps or services are doing well, sitting from your offices, across the country, right? So from an entrepreneur's perspective, the best outcome is to have an auction where each of the VCs are in line bidding to enter your company. When I say bidding, it's actual bidding in the sense that you're all putting down your valuations and how much of the company you want to buy a stake. and essentially the company has a choice between 7 or 8 term sheets, and the company chooses which one it wants based on comfort and based on the number on the term sheet in terms of the valuation. So that's obviously the best position, right? You don't need the money. You're not sort of queuing up, going fundraising. People are coming to you based on your traction, based on the marketing or the obvious publicity that you already have, based on word of mouth, which is another very important thing. And then you set up you set up a bunch of calls. You have a bunch of investors, and when one investor knows another investor is interested, that kind of spreads, right? It's a great sign when multiple investors are interested, because that leads to a bandwagon effect where everybody wants to jump onto the bandwagon, and then everybody becomes interested, and then everybody wants to keep a term sheet, and then the entrepreneur is in the best situation there because he picks and chooses, right?
Right. And so at that point, what do you think an entrepreneur should do? Because
so, I mean, I think
because which sort of brings us to the next part, right? Which is that once he's got all these offers, there might obviously be different factors, and at one level the entrepreneur might be thinking just in terms of valuation, but then on the other hand, who's going to join his board and what are the sort of extra credentials of the venture capital firm. So before I think we come down to the valuation bit, I think if you could share your views on how is it that the entrepreneur should be thinking about which VC to go with, and this is regardless of whether he's in a good position or a bad position. Just when he's even choosing which VC to go with, what are the things that you think he should keep in mind?
Yeah, I think what's often forgotten is that the VC business is also a service business, right? In some sense, the entrepreneurs are our customers because we work with them. We want to keep them happy so that they achieve their goals. And just like any other service business, you evaluate your service provider. Find out who's the partner on the VC firm who's leading your deal, and do your diligence on that partner. Find out what he's done before. Find out who he knows, what his connections are. With his permission, you can, and I believe all entrepreneurs should push for this. Ask for reference checks as well. Speak to other entrepreneurs that this particular partner has worked with in the past. Talk to them about how that experience has been. Obviously, through the course of your interactions with the VC, you will understand how they work, how they think, and for that alone, the negotiation is a very good thing, because when you negotiate a big 100-page agreement with a VC, you know exactly how you're going to work with them when things get rough 2-3 years down the line. Okay, but often it's too late at that point. So before that, all the things you can do are do your reference checks. Talk to everybody, talk to other VCs, get their feedback. Talk to if you have an angel, talk to your angels. They're often very well connected people. Find out a little bit more about the firm, because it's not just that single partner who's leading the deal. It's also about the other partners, the senior people. What are their backgrounds? I see a lot of people who come to me and say, I want an entrepreneur on my board, as the partner representing the VC. That has its pluses and minuses. Sometimes you want somebody from a corporate background because you want a lot of B2B introductions to be made. Make the list of all the things that you want your VC to do for you, and go ahead and ask the VC whether those can be provided, and do your own independent evaluation of if those things can be done by that VC with the background that he has and with the people that he knows. Yeah, so do your own diligence, and that's very important.
Mm-hmm. So just on, since you already since we're on that topic, and I know that we are running out of time, but just want to get your views on this other term which seems to be almost abused, though I'm sure there is some there's of course merit in using it, but this term of value add, right, when they say that it's not just dumb money, it's smart money. I wanted to get a sense of from you that how smart of a money is it really, and what really is the value add that a Series A investor or a fully professional venture capital firm bring to the table.
Yeah, I think that's again something that's often debated, but I think there are some things that do happen. in just about all companies that get invested in. One, certainly if you're a B2B company, you can really open doors in terms of the top names in technology, banking, or telecom, all the largest businesses in India. If you have been invested in by a fund with a partner in the US or with experience in Europe, it opens a lot of doors in US and Europe. And I think that cannot be underestimated, because for a lot of companies that are focusing on businesses as their customers, it's very hard to open the door to the to the CIO of say TCS, right? But the VC can open that door because he knows him, he went to school with him, he went to college with him, or he worked with him, right? And that's incredibly useful. That's one thing. And on the B2C side, it's often about on the marketing. It's very important to have somebody on board who understands how marketing happens, both offline, online, all of that. But in my experience, is it oversold, the fact that value add happens? Yes, certainly the VC, it's his incentive to oversell it. But does it happen at all? The answer is yes, and it happens to a fairly reasonable extent.
So, coming to the things that often make or break a deal. Firstly, how is it that a VC thinks about valuation, and how is it that do you think entrepreneurs should be thinking about valuation, especially when they go for their first round of funding? And then post that, we could probably come down to some more specific questions on that.
Yeah, so I mean, valuation this is where it really becomes an art as opposed to a science, because there's no, you can't look up a book to figure out what the value is, and it essentially comes down to a negotiation most of the time. Okay, the VC will look at comparable companies in other geographies which have attempted to do similar things. The VC will look at value of those companies and then say, hey, this company is likely to go on that growth path if it does well, so let's value it based on the valuation of that company. And typically this will be a multiple of revenue. So if you have a revenue of 2 crores, if the multiple in the US says about 5, then we'll say, hey, that's a 10 crore valuation for you, for this company before our money comes in. But this is, this is anybody's guess, really. It could be any number. So again, here, very important that the company does its homework, figure out what other companies in the space, what are they valued at. Typically, it will be a multiple on revenues, because most of these companies will not be profitable. So the best way to do it would be to take a multiple on revenues and look at what you should be valued at, and then add 50% to that, because you're going to be bargained down anyway. Okay, so yeah, so here, it's hard to give a thumb rule, but more art than science. Be well prepared with what's happening with other companies in your landscape is the best advice I can provide.
And so what is the sort of advice you would give? So like, when I look at Venture East's portfolio, right, I notice all sorts of companies. You have a company which is into parking solutions, there's a company into prosthetics. So, there will be certain sectors where it's easier to do the homework in terms of valuation, right? So say, for example, if you're into e-commerce or maybe into some sort of I don't know, making some sort of a CRM or test prep, it might be a little easier to prepare, as opposed to some sector where there really aren't so many people who are a direct comparable, right? There might be proxies and things. So, and I'm sure, at Venture East you would be coming across many such businesses. What happens in those cases, and what is the advice to entrepreneurs there?
Yeah, like I said, it's very hard to often find the exact, comparable in India. It's because most of these are innovative companies. It's unlikely there's a comparable in India, which is why you have to go abroad. You have to look at what's happening in other geographies. And obviously the question is the landscape there the same? Why is a company that is doing the same thing in the US in any way identical to a company doing the thing in India? So, I mean, a lot of this, it comes down to anchoring at the end of the day. If, if the entrepreneur wants a valuation of, say, 50 crores, and the VC thinks it's about 30 crores, if the entrepreneur comes down, sits on the table and says 70 crores is the number I'm looking at, and fights hard enough for that, the number will end up around 45, 50. Okay, I have not been in a sort of a term sheet or a negotiation where the number ended very close to what the VC wanted. If the deal happens at all, it will happen midway with logic. So that's important. So again, you can't find the exact comparable, but think of something, make your case, and don't be shy about making your case. Make it logically, make it with facts, and then any reasonable investor will look at it and evaluate it based on those facts. Okay, but don't make emotional claims saying that I built it for so many years, it has to be 75 crores. That won't work. But logic always works because largely, I think, irrespective of what most people say, I think VCs are a fairly logical lot, at least in these matters.
Right. So coming to first question, which is on the slide, is that finally that when the negotiations go on, while VCs are logical, they are also looking at thousands of companies every year, and they definitely have access to possibly a lot more data points. And how is it that they, what are the tricks that they use to finally pacify the entrepreneur and just make things smooth?
Yeah, so I mean, I guess it's not politically correct to call it a trick, but so typically deals get structured, right? There's much more to it than just the valuation. So somebody could say, hey, I'm investing so much, I will give you your 75 crore valuation, but you have to give me, shall we say, a liquidation preference of 1.5x. And what that means is that if I put in 20 crores today, whenever the company gets sold or goes public, the first 1.5 times 20, that is about 30 crores, needs to come to me. And you'll see that this is in some way equivalent to bringing down the valuation from 75 to maybe 65. Okay, so it's not doing it on paper, but it's effectively doing it. The math does it in the background. And we don't try to be devious about it. It's often discussed, but the problem again happens because entrepreneurs are so hung up on that valuation number that they don't really think about a lot of the other structuring aspects to any deal, right? And everybody does this, right? So note the structuring is all I will say. That structuring, the more structured a deal is, I would say it's likely going against the entrepreneur. That it's likely, it probably means that the entrepreneur got his magic number valuation, and hence the VC is trying to pull him back to what the VC considers the fair valuation in this deal. Okay, so
at this stage, would you then, since we're getting into structuring, what does an entrepreneur do to? I mean, one is of course that he has to be abreast of what are the different structures that can go against him or for him, but in terms of the help that he can take, which is really saying that, do you see a lot of guys who are coming for their first round of VC funding take the help of someone like a financial specialist or an investment banker to help them negotiate a lot of these terms, as well as having their own legal counsel which can sort of help them navigate through this, or do you feel that it's a little too early?
No, typically, I mean, I see most companies at the Series A round have their own legal counsel, definitely, because the agreement is, it's you can't help it, but it's a complex legal document, and you need to protect yourself to get some advice on how that agreement looks like for you. And I think a lot of the legal counsels today are, especially those who focus on startups, are very well equipped to guide entrepreneurs and tell them what's good for them and what's not so good for them. And often they will do this even on the financial aspects, because a lot of this is just, you need somebody to sit down and tell you, hey, this is going to affect you. It's not rocket science. You just need to pay attention to it. So do you need a finance specialist? I would probably say no. You can always ask the VC, hey, give me the results of what happens in this scenario and this scenario and this scenario, and the VC will be glad to oblige. But certainly get your own legal counsel and take their help. They're usually good, and they have a lot of experience, and they're on your side. So that's certainly something I would recommend.
Mm-hmm. And so when you look at a lot of these legal documents which have a lot of terms, there's been a lot of talk, at least in the early stage, seed stage, amongst the investors, of having standardized deal terms, of making this the legal document seem less scary than what it does, or at least less convoluted, because often what gets said is that if things go all right, then everybody's happy, but the legal document really is there to sort of put things on paper and say, what if things don't go according to plan, right? So do you think that there is, or at least do you notice amongst the later stage VCs the document becoming any more simpler, or is it, is it the way it is? Because that's how.
No, to be honest, I've not seen a simple document, okay? And it often depends based on the entrepreneur. So, for example, one entrepreneur I've worked closely with is a very, very smart guy, computer science from IIT. So he'd think of all the edge cases, right? And once you start thinking of all the edge cases, suddenly you're doubling the length of your legal document, because you're negotiating each of those edge cases. And really there's no limit to edge cases, right? You can always say, if this happens at this time, there's no end to it. So different entrepreneurs react differently to it. Which is the reason why you can never make it too simple, right? And they need to protect themselves, as do the investors. So, I really don't see agreements being much more simplified going into the near future.
Right. And so before I move to, the second part, which is regarding dilution and really founder psychology, are venture capitalists and entrepreneurs friends?
Yeah, I think absolutely. I think you can't do. You can't do business. After the money goes in, you both have very similar incentives, right? Mm-hmm. And there's a very strong incentive to work together. At the time of exit is when sometimes those incentives may differ, because the promoter or the entrepreneur might say, hey, I built this company so long, I want to sort of cash out today. Or the investor might say, hey, my fund is drawing to a close, I want to return money to my investors, so I want to exit today. So that often happens at the later stages of the relationship, but certainly at the early stages, the incentive is there for all parties to be friends and work together, and that's what transpires broadly.
Mm-hmm. And so then, on the issue of, what happens when things are working out, but then, there is, while everybody's trying to be rational and there's logic in the air, there is also this other very crucial aspect, especially more and more visible as companies start raising rounds much earlier on in their life cycle of dilution, right? So how much dilution is really, I guess it's not so much about how much is it okay, but how should entrepreneurs really be thinking about dilution, keeping in mind not just their stake, but say the next round of investors that they might be looking at, and to keep them motivated and keep them incentivized. What are your thoughts on that?
Yeah, I think, typically after the early stage round, that is typically after the first 5 million or 20 crores goes into your company, our view has always been that the founding team and the existing team members must hold a majority jointly. Okay, that the incoming investor group should definitely be not much more than 35% of the company, maybe 40% in some cases, but definitely not more than 50%. In other words, the first 5 million has gone into your company, and you haven't diluted more than 35-40%, right? So that's very important, because subsequent to that, you can expect in every round at least 25 to 30% dilution will happen, which means that the promoters are getting so diluted that their incentives are questionable to later stage investors, right? And to keep the later stage investors, interested in this deal, you have to show and prove to them that the entrepreneurs are in it because they have sufficient incentive, at least 25-30% stock holding when say Series C happens. Otherwise, it doesn't make sense for any incoming investor. He'll just say, hey, the entrepreneurs are running this business, but they have only 20% stake. How does it make sense for me to come in, right? So to summarize, at Series A, I would say you should not dilute anything more than 40%. The problem really comes in when you've been invested in by an angel investor, and I have seen various capitalization tables where the angel has taken 25-30%, and the promoters are already down to 70% only after 1 crore has gone in. Okay, for whatever reason. So now you come to the Series A round, and then suddenly the angel plus the Series A investor becomes more than 50%, and the entrepreneur team becomes less than 50%. And as a thumb rule, that's often not advisable. Right? The incentives are just not right for the long term. So if you are raising angel money or even seed stage money, I'd caution against diluting more than 20% at that stage, because the math doesn't work out for the Series C and the Series D investors later down the line.
So isn't that very closely related to what is it that the valuation that you can command?
Correct. Yeah, absolutely true. And it's also closely related to what's the good time and what's a bad time to raise money. Right? So if you manage to raise that $5 million with your company being valued at a $15 million valuation pre-money, then that's fine for you, right? Because only giving up about 25%. But if that valuation of the company is only $5 million and I'm putting in $5 more million today, then I want 50% of the company. And that's not good for you, right? So working backwards, so if you take the average Series A round to be $5 million, ideally you want a valuation of at least 12 million, or at least 10 million, I would say, to be safe. Anything less than a 10 million valuation means that in the long run, perhaps the incoming investor at that point might not be suitably incentivized.
Sure. And so how do VCs start looking at cases where there is a case, because often it can happen that in a lot of cases where the valuation is actually below 10 million, right? And then you have a promoter team which is completely diluted. What are the thoughts that then go inside the minds of the VC, and what is it that they start thinking of in terms of how this team will work? Do they start looking for, are there any backup plans which take place in the mind of the VC?
Yeah, I'll tell you what happens.
Getting another management on board, or
see, that happens not very often in India, at least to my knowledge, because in India, for whatever reason, still we haven't built the capacity to have a good second and third level of management, which means the promoter is still very intimately acquainted with the business on a day-to-day basis. So you can't just put another guy there. It probably won't work. Okay.
Right.
So that's often not an option. Which is why it just puts everybody in a slightly difficult situation, because what it's saying is that you want to exit this company as soon as possible, right? While the entrepreneur still has a sizable chunk, because it's going to be hard to attract investors later on unless the company is an absolute rock star, right? And you can't budget for that. So if you are going into the game, where you're taking a 45-50% stake right up front at Series A, then you want to exit before a Series C happens. You want to exit with only one more round of funding at most. So you're coming in knowing that you're not going to be in for the long run in this company, right? So that's the only way to go around it.
Got it. And so then how long does closing a round usually take? How much time do you think it would take? I think to this part, it would be helpful if one were to also sort of look at the whole process, right, from the time when the entrepreneur starts contacting the VCs to the point where one of them is interested and finally the documentation is done and the money is actually wired into the bank account.
Sure. So, short answer is it takes anywhere between a month and 6 months. Okay. And why is that? So what are the various steps involved? You have your first meeting, you have your second meeting. Internally, the VC firm, has an internal call or a meeting to discuss the proposal. And if they like it a lot, often a term sheet is provided, often, not often, but sometimes within 15-20 days. Okay. So the term sheet is provided. The company looks at the term sheet. If they like the valuation, if they like the other terms that are on the term sheet, they sign up, which means immediately the diligence, the financial and the legal diligence processes start up. What financial diligence means is that a third party is usually employed by the VC to look into your books, look into your accounts, how you managed all of that. So one advice is that make sure that your books are in order. A lot of the time this takes much longer than it should, simply because the company is so involved in building the business that it neglects the accounts and it takes time. So the legal diligence and the financial diligence takes place through the third parties, and then the negotiation of the agreement takes place, right, before the final closing when the money actually hits your account. So all of this, best case I have seen, I've seen deals happen, somewhere between 30 and 45 days, and worst case, we've seen deals that take more than a year because the promoter can't make up his mind whether he wants the money now or not. But assuming everybody's on the same table, it can go up to 4 or 5 months.
Mm-hmm.
So I'd say 45 days to 4 months. Yeah.
45 days to 4 months, right? And then there are those cases where you're saying that the promoter actually gets funding after a year. In fact, if I were to speak from my experience at Avishkar, a lot of times there have been a couple of instances where we've engaged the entrepreneurs at least for 1 or 2 years because they were just way too early and they had come to us with just a plan on paper, and then it was the whole process, I think, took at least 2 years, and now they are one of our best performing companies. So on that note, right, so then which sort of takes us to this very interesting part about on no, right? Where do why is it that the proverbial saying is that VCs never ever say no, and they might take the longest time to say yes, but they'll never ever say no.
Yeah, so I guess everybody likes to hedge in life, right? Because VCs are always afraid of coming off as idiots. If they go ahead and say no, and the company goes ahead and becomes the next Facebook, it doesn't look good for them. They don't want to shut the door ever, because if they're missing the Series A bus, they would like to come back at the Series B and say, hey, you know what, we made a mistake in Series A by not considering you strongly enough, but we can look at the company now. But by saying no, you're essentially shutting that door, which is why, if somebody is saying no to you up front, then you usually know that you need to do a lot of work before you can come back. If the VC is sort of dilly-dallying and he's saying that, hey, looks good, but ABC, then you really need to go work on that ABC, but you have a chance, right? So, I would only be wary if, the VCs are saying, if a lot of VCs are saying no very quickly, then you know that you're doing something very wrong, right? So take it in that spirit.
Right. And so, does it happen sometimes that everything is okay, you have a great team in place, there is substantial traction, you're in the right market, and even despite that, the VC can sometimes say no, and the entrepreneur is left thinking, what did I do wrong?
Oh yeah, absolutely. That's a good question. So, so that differs fund by fund, right? There are some fund-related peculiarities. One is that you might already have a company doing something similar in the same market. As a sort of a gentleman's agreement, you might not invest in a competing company in the same market.
Even though
so
it
that
might be
sometimes
doing
happens.
better at that point of time than the company in the fund, right?
Yeah, exactly. Yeah, but that's just courtesy, and it's a question of honor more than anything else, right?
Right.
That's one. The other and often very common reason is that funds have life cycles as well, right? So as Venture East, we go out to our investors and raise capital. That capital needs to be deployed typically within 5 years. So if we are reaching the end of that 5 years, we automatically become significantly more selective, because we may have only 5 million left. We can do only one more deal, but here there's 50 deals on the table right now, and so you might be doing good, but there may be one guy who's just better, right? So if you had come maybe 2 years earlier, we would have done the deal, but now there's no money, there's much more competition because we have only 5 million left. So hard luck to you. Right, and that also happens, and because all funds have their life cycles, it will happen with all funds now and again. But there's nothing you can do about it except do your research and ask the right questions up front. And typically people are transparent, right? If they don't have much money, they will tell you that the bar is much higher at this time, and you should be prepared for that.
Right. And so, I am asking this question at the end, but in fact it should have been asked at the very beginning, is that how does one engage for the very first time with an early stage VC? So if they are going for their first round, like you said, the preparation has to start in advance because it can consume a lot of your time. But that initial contact, how does one make it? In a lot of cases, probably the VCs will identify you and reach out to you. But if that is not the case, what are some of the finer points on how to establish that contact with the VC firm?
Yeah, the best way is always to sort of build a personal relationship with one of the VC community, right? This can happen various ways. It can happen, I've seen it happen through social media. It can happen through conferences, which happen now and then. Build that rapport with that individual. It's often better if he's a more senior person, but even junior works okay. Build that rapport, tell him about what you're doing. Don't do a formal pitch right up front. Just elicit feedback, because it's likely that he's seen somebody doing something similar or in a very neighboring market. So he'll be able to give you feedback without the pressure of, hey, I'm evaluating this, I need to give a yes or a no. And over time you'll see that when you come back with a formal pitch, they're much more likely to listen to you, because they want to see if if you've taken the feedback they've given, how you've grown from that point. And there is a certain sort of relationship that is already there, which you can build on. And how that also helps is later on that person, even if his fund is not interested, he can potentially refer to you to his friend in the VC community who can look at the deal. So the worst thing you can do is to just do a sort of a cold email to any VC firm saying, I'm doing this, do you want to look at me? Simply because there are too many of those, and it's likely that you will get lost in the mess of hundreds of emails that we receive every week. So build that personal relationship, seek them out in an informal setting, talk to them. They're always happy to chat. At least in my experience, people have always been open to talking to entrepreneurs. And we'll provide the feedback, and then come back with the formal pitch and take it from there.
Great. Shashank, I think we can take a few questions right now. Hello?
Rishabh?
Yeah.
We can begin the question and answer round.
Right. So will people be typing it here?
Yeah, I already have enough questions
So
in the panel here.
great. So I think you can just start shooting them one by one, and Rahul could take them.
Yeah, sure.
Okay, the first one for you is from Manoj Patel. He wants to know whether it's a good idea to have two angel investors and one venture capital investing together, and what are the hurdle or what has to be kept in mind to have a success in this kind of a plan.
Well, I mean, it's not a very common thing. Firstly, I mean, I know it's happened now and then, but it's fairly uncommon. But if they're coming in together at the same time, that's really not a problem for you. In fact, it may even be better because it's one more influential person on your board who can help you network with the right people. So, I don't see it as a negative if they're coming in simultaneously. If they're coming in sequentially, then you have the problem that I mentioned, that you're diluting too much too soon. And that's something you need to watch out for. If they're coming in at the same time, I think the more the merrier in this case, more people to help you. One more stakeholder to manage, and that's something all companies need to remember, that one more investor always means one more line of relationship that you need to maintain and support and provide information to. And often for early stage companies, that's a challenge because they're so low on bandwidth. But apart from that, I'd say not a problem.
Rakhi Mehra has this next one coming up for you. She says that she's an organizing of sports tournaments only for corporate companies. The revenue is around 60 to 66 lakh, and they've started operation in 2009. They have around 600 corporate clients with them right now, and they want to know whether venture capitalists would be interested in this business, and would they be interested in investing in this venture.
So 60 to 66 lakhs, as I said, is probably too low a turnover at this point for an institutional early stage investor to look at it. Simply because, as I said, we put in about 10 crores at the very least, so the company needs to have some scale, at least a couple of crores at the very least. So 66 lakhs is probably too low. Will an angel investor look at it? Yeah, he might look at it. Or a seed stage guy, yeah, he may look at it if he finds the opportunity compelling enough. And that, as you know, goes on a case-by-case basis and an individual basis. But just a priori, 600 customers is very good. Though somebody will ask you, if you have 600 customers, why do you have only 66 lakhs in turnover? And how hard is it to acquire that one customer to provide you only a few thousands in revenue? Right? So those are the questions that will come up. But the broad answer being early stage, no. Seed stage may look at it if he thinks that it's scalable and it's interesting.
Rebecca Kumar has this next one for you. In the seed funding or the angel fund raising time frame, what kind of oversight or control should the investors expect to have over the startup's business decisions? Will the company still have autonomy?
Sorry, what's the last sentence again?
Will the company still have autonomy?
Oh, autonomy. Okay. Yeah, I think the answer to that is yes, the company will still have autonomy. Mostly the the investors do not interfere too much in operational decisions. At a strategic level, say you're planning to move into a completely different business line that is somehow related, yes, the VC then will certainly have a say at the board level. But operational level, unless there is a specific request that comes up from the company saying we need help here, the VC will just ensure that the hygiene aspects are there, that is the financial reporting, the internal controls and systems are in place. They won't venture so much into the operational aspects. So that's the answer.
Pradeep Jain wants to know whether he can get a VC funding or an angel investing for solar related projects, as there seem to be most of the funding for only online ventures or ventures which are related to the IT field.
Yeah, I mean, sure. I think if you look at, there are plenty of databases out there and you'll see that a lot of solar companies have received funding. It's sort of dried up over the last couple of years because people have discovered that it's a hard market to crack in India, but there's no reason in principle why a solar company will not be interesting. And as to the other point, again, you will also see if you sort of review what's been happening that certainly the old e-commerce deals are no longer happening in the market. People have become more sophisticated. So certainly there's a wide world outside just IT and e-commerce, and those deals are happening, and certainly solar I believe will come back into force very soon, so no reason not to try.
We'll be taking the last two questions for the day. The penultimate one is from Maheshwar. He wants to know whether is it a good idea to approach more than one VC for funding. If it takes more than 4 months to get a funding, do you think this is a good idea? And do we need to be transparent about this with the other venture capitalists as well?
Yeah, I think the answer to both of those is yes. There's no point going to just one VC. You want to go to 10 VCs, 20 if you can. It's only limited by your own bandwidth. So go to as many VCs as you can. Should you be transparent about it? Yes, because it builds in that competitive spirit amongst the VCs themselves. If a lot of people are looking at the same deal, they look at it much more closely because they don't want to lose out on a good deal. So yes, be transparent about it as well.
Sumit Kaul has this last question for you. If one company in some segment has got funded but has not done that well, does this make life difficult for other entrepreneurs who will be operating in the same segment?
Yeah, so that's a good question. I think the broad answer to that is it depends how long back that company failed. If it failed maybe about 12 to 18 months back, then I would say it's probably a problem, especially if a lot of money has already gone into that segment. So e-commerce today, if you go with a straight e-commerce deal to an investor, they'll say no out of hand. Okay, they won't even entertain you because they've seen a lot of money go in and get burnt, right? So your timing needs to be right, or you need to be doing something substantially different from the company that failed. You need to know why that company failed and talk about how you're solving the problem. So don't ignore it, be proactive about it, identify the risks and talk about how you'll address them. And if you do that, there's no reason why you won't be attractive.
Well, that was the end of today's session. Thank you very much for that interesting webinar. Thank you to all our attendees for participating in this event. We are glad that the questions kept coming in, but due to a lack of time, we are unable to answer them all. If you found the session interesting, tweet at @NEMIndia with #FirstRoundVenture. The recorded version of the webinar will be available at www.youtube.com/user/eClubNEMonline by tomorrow. After running a very popular webinar in key legal and regulatory procedures for startups in India last month, we present another version, this time in Hindi, by Deepak Khaitan, who had successfully led the same webinar the last time. NEM has also workshops lined up for you this month. On November 23rd, there's a Getting to Market workshop in Coimbatore and Nagpur, and one on key legal procedures for startups, a legal one in Pune. The registrations are completely free. So thank you once again and have a nice evening.
Thanks a lot, Shashank. And thank you everyone for attending this. I hope that you found it useful.
Thanks guys, thanks everyone.